Good afternoon. I hope everyone's new year is off to a great start. I want to welcome you to this Learn at Lunch webinar. Today, we will hear from Extension Livestock Marketing Specialist, Dr. Darrell Pill. He will discuss what is happening in the current livestock market. If you have questions, you may ask them through the chat window by clicking the chat button at the bottom of the screen. You may find more information on this and other farm management topics on the eFarm Management page. I will share this link in the chat window. Dr. Pill, I will turn it over to you now.
All righty. Well, thank you, Brent. Appreciate that. Thank you, everyone, for joining this afternoon. We'll run through a quick look at the high spots, at least, of this cattle market. Very dynamic market and very unprecedented in many ways. So, with that said, I will jump in here, go through. I'm going to try to run through some things here pretty quickly and still leave time at the end for a couple of questions if we have time. So let's take a look at this thing. In some ways, we could probably do the whole talk from this chart. This shows prices. The blue line is calves. We got big feeder cattle in the green line, fed cattle. So this shows cattle markets. The far right-hand side, of course, is where we are now, and in relation to the last 15 years or so. And, you can really see, obviously, we've been on a tremendous climb in this market since late 2022 is when it really took off. And we continue it. And obviously, what you want to know most of all, and what producers want to know certainly is, where do we go from here? Are we still climbing this hill? Are we close to the top? Are we at the top? And we'll come back to that and talk about it at the end. But this has been a very long run. And I guess as a spoiler alert, the answer is no, we're not quite at the top based on the fundamentals that we have. So with that in mind, there's a lot of nuances in this that I don't really have time to get into. But, the market is very focused on the cow-calf sector. This thing is being driven in large part by cattle numbers or lack of cattle numbers, which we will take a quick look at here. But so the market is providing incentives in the form of calf prices primarily to the cow-calf sector to rebuild supply in this industry. And everybody else kind of gets involved in various ways. Cow-calf producers are enjoying this market. Everybody else, not necessarily so much, depending on what your role is in this industry. So here's a quick history on how we got here. Bottom line, a year ago, January of 2025, we had the smallest beef cow herd since 1961. And we'll be getting new numbers in about 2.5 weeks from USDA. I think there's a good chance that we will be just fractionally higher than last year, which would make 2025 the official low for this cattle cycle. It's going to be plus or minus unchanged, probably. So we're not going to grow a whole lot going into 2026, but we may have stabilized at this point. We'll talk about that a bit more. More importantly, from the standpoint of what this means for cattle, for beef production and consumers, is the calf crop. The calf crop that's projected, we'll get final numbers here soon, for 2025 is the smallest total U.S. calf crop since 1941. And so, obviously that's a multi-decade situation we've not seen in a long time. And perhaps more importantly is the fact that the calf crop most recently peaked in 2018 and has gotten smaller each of the last 7 years. So we've continued to tighten up the supply of cattle that the rest of the industry works with, and all of our beef production comes from as a result of this. As a result, cattle on feed inventories are starting to decline. We simply don't have the cattle to support them. It's actually been kind of a slow decline relative to the on-feed inventory. Feedlots obviously try to hold their inventories as long as they can, but when you look at the throughput of feedlots, the actual production coming out of feedlots in the form of placements going in and marketings coming out, you can see that it's been declining over the last several years, and it's declining more rapidly at the current time. And that's a reflection of the fact that we simply have this tighter and tighter feeder cattle supply, which is being manifest now in terms of smaller or lower feedlot production, Lower feedlot production leads to lower cattle slaughter. And I'm one slide ahead of myself here, I think. One of the reasons that it's been a relatively slow decline at the feedlots is because we have continued to place and feed heifers. Now, that's going to come back on the flip side when we talk about the cattle cycle and where we go from here. Obviously, if we're still feeding heifers and using them for beef production on that side, that means that we're not using them for breeding, and so that becomes an important point when we think about where we go from here. Cattle slaughter is decreasing. Again, we have less cattle, we have less feedlot production. It's beginning to sort of gain momentum, if you will, those tighter supplies. So cattle slaughter was down in 2025. All classes of cattle, steers, heifers, dairy cows, beef cows, bulls, were down across the board. Heifer slaughter was down a little bit more than steer slaughter, so we're looking for signs that we might be starting to retain some heifers. They're pretty minimal at this point, but the bottom line is slaughter is down, and so slaughter is being decreased slaughter, I should say, is being partially offset by increased cattle carcass weights. Feedlots, so one of the ways they've tried to hold inventories is to feed cattle longer. There's less cattle moving through the system, but the ones that are there are staying in the feedlots longer. Carcass weights have accelerated sharply in the last 2 years, in 2024 and 2025. That partially offsets it, but it doesn't completely offset the lack of cattle, if you will. And so as a result, this orange section of this table shows this has beef production in 2025 down 3.7%. We're still getting the final numbers in. I think it may actually wind up being around 4% decrease, maybe even 4.2% decrease, a little bit bigger than we've got here. And, going forward for 2026 in the green section here, we're looking for additional decreases in beef production in 2026. In fact, this diamond is a projection of where we are now at the end of 2025 with decreased beef production. We've got it down for 2026 and 2027 going forward. Kind of no matter what happens, the intent of producers relative to herd rebuilding will impact sort of how much of this happens, but it doesn't really change the fact that beef production is going to continue to fall for the foreseeable future. As a result, of course, we've seen continued strength in prices. So wholesale values, the blue line was 2025, sharply higher year over year. We're starting off 2026 here with just a couple of weeks of data. Higher than a year ago. I expect these to continue to be strong. We're still trying to kind of get past the holidays and see where markets are, but every indication is that we continue very strong. Retail beef prices, as reported by USDA, continue to increase. The most recent data here is for November of last year. We'll get the December data here in just a few days, I think. But retail beef prices continue to go up. This has been obviously something we've been kind of concerned about, or obviously we're at record levels, and there's a lot of questions about just how high we can push these from a consumer standpoint. At what point will we exhaust this, or could we exhaust this and see some pushback? And the short answer is we just don't see it yet. Beef demand has been remarkably robust, and even though we've continued to push these retail beef prices higher, this chart shows the blue line is retail beef to retail broiler or chicken prices, and you can see that gap continues to widen. And the same is true on the red line with beef to pork prices. So there's plenty of other meat out there. In that table we looked at earlier, I forgot to mention that, but beef and pork and poultry supplies are ample. There's lots of protein sources that consumers could turn to. We just don't see much indication that they're turning away from beef, and they continue to pay even higher relative prices as shown by this chart. So beef demand is very robust. We don't have a beef demand problem at this point. Obviously, things can change, so we continue to monitor it, but nothing seems to indicate that we've got any significant issues here. Just a couple slides on the trade situation. We could obviously spend a lot of time on this. Excuse me. As we got into this, we knew beef exports would likely come down just because we're in a tighter supply, high price scenario. And then, of course, we've had a lot of political actions as well. So the biggest impact we see here for the first 10 months of the year, by the way, we're still catching up on this data. We just got the September and October data a few days ago, trying to catch up from the shutdown. But the biggest impact thus far has been in China, Hong Kong market. We are essentially out of the China market right now as a result of the tariffs and trade war situation. And so that has dropped sharply. Those exports to China, Hong Kong combined are down about 50% year over year. And at this point in time, we don't even have clearance to export, and obviously with lots of tariffs in place and so on. So we haven't talked much about this because the domestic U.S. market has been so dynamic that hasn't received a lot of attention, but I think we will pay more attention to it as we go forward. The import side is kind of the flip side of that. As we get into tighter supplies and higher prices, we expect to see increased imports. Obviously, markets are attracted, other supplies of beef are attracted to the U.S. market. In particular, processing type beef, which is a lot of what we import, because our tightest supplies in the U.S. are actually for lean beef that supports our ground beef market. Cull cow slaughter is down the most of all of the slaughter categories. And so we've seen sharp increases. Through October of last year, imports were up about 20% year over year for that 10-month period, with Australia and Brazil being the big ones. Australia was actually the biggest, although in the first 6 months of the year, Brazil was the biggest. But then again, we had a lot of tariff issues with Brazil in the second half of the year, with increased tariffs, then the tariffs removed, and lots of dynamics in that. But going forward, we expect to continue to see beef imports to supplement declining beef supplies in the U.S. And, again, we still have record prices even with this level of imports. I need to talk a little bit about the Mexican border situation because of the New World screwworm issues that we've been monitoring, and the threat from that getting into the U.S. The biggest impact of all is already in place, and that is that the border is closed. So this chart shows that historically we have imported about 1.1 to 1.2 million head of cattle from Mexico. The border has been closed for over a year, mostly. We closed it initially in November of 2024, and then it was opened very briefly between February and May of 2025 with new protocols in place. We got about 230,000 head of cattle across, and then with new threats, the border reclosed, open for about 48 hours in July, but mostly closed in 2025. So we probably got about 700,000 to 800,000 head less cattle from Mexico in 2025 than we would have gotten under normal trading or a historic trading situation. And so we do expect at some point the border will reopen. There's probably some backlog of cattle, but most of those cattle that didn't come across last year have already been reabsorbed in the Mexican market. They continue to utilize those cattle, and in fact, the longer this thing stays closed, the more adjustments that they make on the Mexican side, and that may have some longer lasting impacts on the trade relationship going forward. In the short run, of course, the lack of Mexican cattle is one more factor contributing to tight feeder cattle supplies and helping to support prices at the margin in the U.S. It's not the major factor, but it is significant and relevant at the margin. So, last couple slides, I'm going to try to save a few minutes here. Back to the cattle cycle. Again, if you look on the right-hand side, I put in the idea that we might see a very slight increase in beef cow herd for January 1 of 2026. I think it'll be pretty minimal. And it's based on the fact that we have decreased cow culling enough to stabilize the herd at the current low level. We have not saved enough heifers to allow for any significant growth. We can just stop liquidating, basically. So the question going forward here, if this is the low or if we're kind of at a flat spot here on the bottom, what does the next expansion phase look like? The market's trying to encourage expansion with calf prices. If we look at the last expansion, which started in 2014, peaked in 2019, what do you have to do to put together that kind of herd expansion? Well, you do two things. You cut cow culling to a minimum, which we are doing. You can see over here on the right-hand side, projected net culling rate for the beef cow herd in 2025 was about 8.4%. That's certainly low enough to suggest that we are trying to stop liquidating the herd. But the other half of it is heifer retention. The blue line goes up when we're expanding the herd. We save heifers, add them to the herd. We have not started that process yet. On the far right-hand side, you see here that heifer retention has not ticked up yet. And this is annual numbers, of course. And again, we monitor this from the flip side by monitoring some of the slaughter stuff as we go through the year. Again, on annual numbers, you can see the difference between now and what happened back here in 2014 to 2019. We had actually been building heifer supplies even prior to the beginning of herd expansion in 2014. We have not been doing that. We have actually been pulling down heifer supplies in the U.S. This is replacement heifer inventories continue to get smaller as we have utilized heifers for beef production rather than for breeding. So we don't have a pipeline of heifers to work with. We have very limited prospects for growth. And when we start that heifer retention process, it will take some time for it to really mean anything in terms of significant herd growth. So this expansion and high price cycle is starting slower. It may be starting. I'll show you an indication here in just a second that it's probably starting, but at a very minimal level up to this point. And so it's going to continue for an extended period of time. And there's a number of reasons why. We just don't have the females in the short run, but then we've got drought issues that we're still monitoring. We've got financial issues we're still monitoring. We've got producers making decisions about whether they're going to continue in the industry going forward. All of those things contribute to the process of changing the cattle cycle from a minimum level back into a herd expansion level. The market is providing incentives. Cow-calf returns, again, the market's focused here, providing incentives and motivation for the cow-calf sector to begin that herd rebuilding process, but it's been very minimal up to this point. And I guess I took all those slides out, but there are some indications from the slaughter side that we are just barely beginning to potentially save some heifers. I told you that heifer slaughter was down relatively more, for example, compared to steer slaughter in 2025. There are some indications that a very minimal level of heifer retention may have started in 2025. But the bottom line is we've got more ahead of us, and that means that out of a tight feeder supply, that small calf crop from 2025 that carries over into this year, if we do start saving some heifers for retention, we're going to squeeze feeder supplies even tighter. Feedlot inventories will fall faster and farther. And that means that we likely have not seen the highest prices for cattle. This is the kind of the end. This is where we end up here with, even though we're at record levels, and as scary as it is to say, in some sense, I do expect higher average cattle prices in 2026 and probably into 2027 or through 2027 as well. Just don't think that we can put together enough herd rebuilding. Now, eventually we will respond. There will come a day someday when we increase production enough after that process that we'll put a top in this market and probably come down a backside. But all of that's going to happen late in the decade, if in fact it happens yet in the decade. I think we're going to be in a very strong supply situation for most of the rest of the decade at this point. And again, as long as demand continues strong and there's no indication that that's changing, then we're likely to do that. So, I've kind of summarized. You can read the bullets here. We've said all of this, other than the bottom bullet, that bold statement. One of the things producers are dealing with is the fact that even even at record high prices, we've got a tremendous amount of volatility in the market. There's a lot of risk short term to producers as these markets are subject to a lot of very short term shocks. The fourth quarter of last year was very turbulent, and we did see a significant market correction. And then as soon as it stabilized a bit, we have bounced back very strongly. We're starting 2026 with cattle prices very strong and back to these supply fundamentals that are driving the market. Volatility and risk continue to be an issue for producers, even in this environment, and that's something that producers need to plan on relative to those periods of time when they will be marketing cattle, because we're certainly subject to a lot of short-term risks. So that said, we've got a few minutes yet for some questions. Brent, I don't know if we've got any questions in the chat or anything at this point.
I haven't seen any questions to this point.
All
I
right. Anybody have any? That was very quick. Obviously, we're skipping over a lot of detail, but at the same time, those are the main highlights at this point for this market. So,
We did get our first question, Dr. Peel. If packer margins are negative, what are the implications?
okay, yeah. So I didn't talk a lot about the margins. But I did mention the fact that it depends on who you are in the industry, how much you're enjoying this. So the market is focused at the cow-calf level. Everybody above the cow-calf level in this industry is a margin operation. It's all about some buy-sell spread, and that's true at the stocker level, which is not being encouraged in this market. At the feedlot level, they've done pretty well up to this point, but they're going to see some challenges. The place that has taken the bulk of the margin squeeze that's implied in this kind of a market has been at the packing level. So packer margins have been significantly negative for an extended period of time. We have had some announcements, of course, in the last couple of months about some adjustments. Tyson announced that they're closing one of the Nebraska plants and cutting back in one of the Amarillo plants. And this is, given what I just said, this situation generally is going to continue going forward. So we could well see some additional adjustments. Now, the adjustments we've seen so far, relative to the question specifically, the implications, there's some regional implications, obviously, as markets readjust, particularly in that Nebraska region. But by and large, we still have, at the moment, excess packing capacity. I mean, obviously, that excess capacity is the challenge that packers have faced, and Tyson making decisions relative to their ability to operate with limited cattle supplies. The adjustments in total that come from the adjustments Tyson has made do not actually change the overall excess supply in the industry. So it will continue to be packers chasing cattle. Again, there's some regional implications. But that Nebraska plant was in the middle of a bunch of other plants, and that's probably one of the factors that contributed to why that particular plant was chosen for closing. So there'll be plenty of demand for the cattle that are out there for the foreseeable future. Again, we may not be done if this continues on. Who's to say? Packers may make some of the other packers may make some adjustments. Now, at some point in time down the road, when we rebuild enough, then we could get back into a situation where we have a lack of packing capacity. We have seen that in the past. We had that in 2019 and 2021. And so we could get back into that, but that's probably several years away at this point.
Thank you, Dr. Peel. I don't see any other questions after that. I also shared a link to a webinar survey, a short survey. So I would appreciate it if you would all fill that out and give us some feedback on these webinars and let us know how we're doing. That link I shared in the chat window. And also, thank you everyone for joining us today. I have not scheduled our February webinar, so I don't have a date on that yet, but I will let everyone know through our normal channels once that is set. And then So you can hopefully join us in February for that webinar as well. Dr. Peel, if you don't have anything else, that's about all I have.
No, thank you very much. Obviously, I have my contact information up there. Feel free to get a hold of me. If you're interested in the newsletter, you can send me an email, or the QR code was there for you to get signed up for that if you're interested in that.
All right. Well, thanks everyone.